Welcome to EAGTAX and our tax advent calendar, where we will be sharing tax tips and explanations in the lead up to Christmas. For day 15, we will take a look at business asset disposal relief. The successor to entrepreneurs relief, business asset disposal relief lifetime allowance only covers £1 million of qualifying gains, having previously been £10 million. This relief means qualifying gains are subject to a 10% tax rate. If your income and gains do not exceed the higher rate tax threshold, you would only be subject to 10% CGT anyway. Therefore, this is more relevant to non-basic rate taxpayers and those with large gains. Qualifying capital gains relate to a sale of an unincorporated business or a distinct part of a business, a sale of assets used in a business which has now ceased, a sale of shares or securities in a personal trading company, and associated disposals. Since there are some interesting complexities in relation to personal trading company shares, we will focus on this. So the basic condition is, throughout the 2 years up to the date of sale, the company must be the individual's personal company, the company is a trading company or a holding company of a trading group, and the individual is an employee or officer of the company or group members. So what is a personal company? You must own at least 5% of the company's ordinary share capital. Do take care when considering whether all the shares are ordinary. Just because a share class is not called ordinary doesn't mean they aren't classified as such. Secondly, by virtue of this shareholding, it entitles you to at least 5% of the company's voting rights, and either 5% of the profits available for distribution to equity holders and on a winding up, or in the event of a sale of the whole of the ordinary share capital of the company, you will be entitled to at least 5% of the proceeds. Once you've made your way through those conditions, you then need to determine whether the company is trading. Initially, you must consider non-trading activities and whether these are substantial. The starting point is to look at income, expenses, gross assets, and time employed of each activity. Crudely, HMRC considers substantial as exceeding 20%. Unless you are happy to cover legal fees for tax tribunals, the lower the investment activities are, the better. Care is also required where the company or group holds interest in partnerships or non-controlling shareholdings. If the company ceased to trade before you sold or dissolved the business, you have an extra 3 years in which to claim business asset disposal relief. The personal company test does not have to be met by shares acquired through the HMRC approved share scheme plan known as EMI, but 2 years need to pass between when the option is granted and the date of sale in the basic form of this relief. There is also a provision where you no longer meet the personal company test as a result of incoming investment diluting your position. This is available if business asset disposal relief would have been due immediately before the dilution. It also provides a further election to enable this notional gain to be deferred along with the tax charge. Those incorporating their business, recognising a goodwill value on transfer, are unlikely to attract business asset disposal relief unless the incorporation is taking place to facilitate a sale within 28 days of transfer. There are also circumstances in which trustees may make a claim for business asset disposal relief. This is only possible if they make an election with a qualifying beneficiary. Remember, just because a company qualifies under one capital tax-based relief doesn't mean they will meet them all. For instance, companies with investment assets restrict the availability of gift relief, which we covered yesterday. We hope you found this useful. Please take a look at our website for more information and contact details at eagtax.co.uk.